Unemployment rate fell to 3.6% in May, reversing the expectation of a gradual increase in the number of jobless here. And it spooked the markets, as Ed pointed out. But let's be frank here, a lower unemployment rate is actually good news for Australia, even if it does bring pressure for interest rates to rise. Employment grew by 76,000 people. The unemployed, it fell by 17,000. That's good news. People have jobs and wages. The employment to population ratio is a record high. So too is the participation of women in the workplace. This is, again, good news. Let's bring in here Sally, JBWere's Chief Investment Officer, Sally Auld, who joins me now. Sally, it's good news, but the markets were spooked because they can see rate rises coming, can't they?
Yeah, that's right. So when we heard from the RBA earlier this month, they said they're worried about upside risk to the inflation outlook, and part of that concern stems from the fact that labour market's really tight, there's upward pressure on wages. And even though the RBA governor says, we think strong wages growth is a good thing, but it needs to be accompanied by productivity growth. And we don't have any of that at the moment. We've basically had zero productivity growth over the last 3 years. And so that combination of strong wages growth, tight labour market, no productivity growth, unfortunately is not consistent with inflation in the target. And that's what's making the RBA uncomfortable.
OK, so then contrast Australia's economy and where it sits right now with the forecast of at least 2 more rate rises from most of the major banks to what we've seen in America overnight, where inflation has eased back to 4% over in the last day or so, and the Federal Reserve has taken that as a sign that it can start to just basically pause these interest rate rises for some time.
Yeah, so the Fed's a little bit more advanced in its tightening cycle. It's lifted rates 500 basis points over the last 15 months or so. So they have a higher policy rate than we do here in Australia, and are probably seeing a little bit more good news on the inflation story than is the case here in Australia. So at the moment, I think the Reserve Bank pretty comfortable that inflation has peaked for the cycle, but they're worried that it's not coming down fast enough.
And then that employment number today simply reinforces the fact that if you've still got pressure in the labour markets and pressure for wages to rise, that the inflation is going to be more sticky than they anticipated.
That's exactly right. And so this is why the equity market took it as bad news, because it basically increases the chance that come early July, when the RBA board next meet, that they'll decide to deliver another 25 basis point rate hike.
But for business right now, many of those businesses are surviving on the demand from consumers. In other words, people being able to shop. That's because they've got jobs. If all of a sudden we discover that there's 200,000 or 300,000 people out of work because the unemployment rate rises, it might take pressure off interest rates. It certainly doesn't take pressure off families or potentially off business, does it?
Correct. And this is the really tricky part of it. So the RBA have been trying to sort of deliver, I guess, the best of both worlds, to try and bring inflation down over a reasonable time period, but to do that in a way that doesn't create too much collateral damage in the labour market. So trying to really preserve all the gains we've made in terms of getting to full employment. And that's been their approach, and sounds sort of sensible. The problem is it's a difficult one to engineer, and history tells us that there aren't many central banks, when we go back over time, who've been able to sort of deliver on both of those fronts. And so I think the higher rates go, the chances of us having an economic outcome where we sort of have our cake and eat it as well are getting smaller.
OK, so when we sat and talked to Alan Oster from the National Australia Bank the other day, he put the odds of recession at about 50-50, basically saying that the narrow path that we're on is getting narrower at all times. Is that your own prognosis when you look out 6 to 12 months? We know the economy is going to slow. That's been forecast by the Reserve Bank, by the government and everybody. But it's just how much it slows and how much the pain is going to be felt by corporates and also by families.
Yeah, no, I think that's a fair characterisation. But what it tells you is that we now have an economy where the outlook is quite vulnerable to any sort of adverse shock, whether that's something that comes from offshore, whether it's something that comes from Australia. It's not going to take much for that path to basically be as narrow as a piece of string. And so I think it tells you that we are at a bit of a sort of inflection point for the outlook, where you look at most economists' forecasts, particularly Alan's forecast, like he's probably taken out as much economic growth as he can out of his forecast without sort of officially falling into the recession camp. And I think the story that economists and the market is starting to understand is that actually, maybe there are some lessons from history, which is that when you're trying to engineer these really big declines in inflation, it's pretty rare that you can do that without pushing up the unemployment rate.
OK, so we're seeing here the cash rate, right? And we've seen the aggressive rises and then the pause and then they go again. But, you know, you go to New Zealand. We'll talk about New Zealand very shortly falling into recession. You go to the United States. You go even to the UK. They were much more aggressive, and Canada, much more aggressive in their rate rises than even Australia. The idea was, because we have variable rate home loans, that these rate rises should have really changed the behaviour of people. It doesn't seem as though really, maybe in hindsight, they went hard enough soon enough.
Yeah, so there was always this story that maybe we're a bit different in Australia because, as you said, we've got all these people on variable rate mortgages. You know, for a while it looked like our wage growth was sort of better behaved than in other countries, and even our inflation rates weren't as high as some of those other countries. But I think as time has gone on, you know, what we've realised is that actually maybe the wage growth story isn't so exceptional here, and inflation was sort of on par with a number of other economies. And to a certain extent, we've been protected, or a lot of mortgage holders have been protected because they've been on fixed rate mortgages that they took out at those really low rates. Now, we know that the bulk of those are rolling off or expiring in the next couple of quarters. And so there is an expectation, I think, that some of those previous rate hikes will start to bite. But I think it's interesting to compare against these other countries because the cash rate in New Zealand is 5.5, cash rate in the US is above 5, and they're telling us they've got to do a couple more. And even the market in the UK is saying the cash rate's going to get somewhere between 5.5 and 6. And so you have all these other similar economies where it seems to be that sort of 5 is the new 4.
Yes.
And so the question is, are we really that different? And this is why I think the market's starting to fret that perhaps the RBA's got a bit more work to do.
Sally Auld, good to have you in the program today. Many thanks for your time.
Thanks, Ross.